All right, today we're going to decode a term you've probably heard a million times if you follow investing, the PE ratio. What is it, really?
It's the one question that's always on an investor's mind, right? Is this stock a total bargain? Or am I about to overpay? Well, there's a tool that helps us cut through all that market noise. And, yeah, you guessed it, it's the price to earnings ratio, or just PE for short.
Okay, let's get into it. What exactly is this ratio? How can one little number tell you so much? We're going to break it all down. So, at its heart, the PE ratio is all about value. It's basically asking a really simple question. Hey, for every single dollar this company earns, how much are people like you and me willing to pay for it? It's a straight-up comparison between the price tag of a stock and the actual profit it's generating. And the best part, the math is super simple. Seriously, you just take the current price of one share and divide it by the earnings per share, what you'll often see as EPS. And that EPS, well, that's just your little slice of the company's profit for each share you own. Okay, let's run a quick example to make this crystal clear. Let's say a stock is trading for $100 a share, and over the last year, the company earned $10 for that same share. You just do the math, 100 divided by 10, and boom, you get a PE ratio of 10. That's literally all there is to it. Now here's the real magic in understanding that number. A PE of 10 means that investors are paying $10 right now for every $1 that company earns in profit each year. Think about that. It's the price you pay for $1 of a company's earnings.
Right, so we've got our number 10. But what does that even mean? Is 10 good? Is it bad? Should we be looking for a high PE or a low one? Let's dig in and figure out what these numbers are actually trying to tell us.
Okay, so here's the general rule of thumb. A high PE usually means investors have really high hopes. They're basically saying, we think this company is a rocket ship, and we're willing to pay a premium today because we expect massive growth down the line. Now, a low PE, that's a bit more of a puzzle. It could be a fantastic deal, right? A hidden gem the market has somehow overlooked. Or it could be a red flag, a sign that there are some serious issues lurking beneath the surface. But listen, this is probably the single biggest mistake people make. You absolutely cannot look at a PE ratio in a vacuum. A PE of, say, 20 is almost meaningless on its own. You have to have context, and that means comparing apples to apples, looking at a company and its PE right alongside its direct competitors. And that just makes sense, doesn't it? I mean, you'd expect a hot new tech company to have a much higher growth ceiling than, say, a stable old-school utility company. So investors are willing to pay way more for that future tech growth, which drives up the PE. Meanwhile, that slow and steady utility company, it's going to have a lower PE. And here's the thing, neither one is inherently better. They're just in completely different leagues playing totally different games.
So let's take a look at a real-world type of example. We've got two companies here, both in the consumer goods space, Fresh Bite and Tasty Treats. Now, look closely. They both earn the exact same amount, $5 per share. But the market is valuing them very differently, giving them totally different PE ratios.
And this is where that context becomes so powerful. Let's say the average PE for their industry is 12. Suddenly, we can start asking some really smart questions. Fresh Bite, with a PE of 10, is below the average. Is that a bargain waiting to be snatched up? Then you've got Tasty Treats at 15, well above average. Are investors right to be so excited, or is that stock getting a little too pricey? See, the PE doesn't just hand you the answer, but what it does, and this is crucial, is it tells you exactly where to start your investigation. All right, but wait, there's one more little wrinkle we need to iron out. When you see a PE ratio listed somewhere, you've got to know, are we looking backwards or are we trying to look forwards into the future? This is where we get the trailing PE versus the forward PE. The trailing PE is simple. It looks in the rearview mirror. It uses the cold, hard facts, the actual, real earnings from the last 12 months. But the forward PE, well, that's more like gazing into a crystal ball. It's based on what analysts think the company will earn over the next 12 months. And let's be real, it's a forecast, an educated guess. And forecasts can definitely be wrong. Let's check out this company, Bright Tech. Its stock is at $100. Over the last year, it earned $5 a share. So 100 divided by 5, that gives us a trailing PE of 20. That's a historical fact. It happened. Done. But now, watch this. The analysts are feeling pretty good about Braytec's future. They're projecting that earnings are going to double to $10 a share next year, So with that same $100 stock price, the forward PE gets sliced in half, all the way down to 10. All of a sudden, based on its expected future, the company looks way, way cheaper. So here's the simple takeaway from all that. If you ever see a forward PE that's lower than the trailing PE, it's a big clue. It means Wall Street is basically betting that the company's earnings are going to grow. And if it's the other way around, well, that means they're expecting earnings to shrink.
Okay, so at this point, it might be really tempting to think the PE ratio is all you need, right? Just find a low number and you're golden. But not so fast. We have to be really careful here because while the PE is an awesome tool, it's not a magic bullet. It definitely doesn't tell you the whole story.
Look, the good things are obvious. It's super easy to calculate, it's fantastic for putting two direct competitors side by side, and it gives you a really fast, at-a-glance idea of how the market is feeling about a stock. But, and this is a big but, it's got some massive blind spots. For one, earnings can sometimes be, well, let's just say creatively accounted for, which can make the PE totally misleading. It also tells you absolutely nothing about how much debt a company is carrying. And it has no way of telling you if a company is just having one good year or if it's built to last for the long haul.
So what it all boils down to is this. Context is everything. That low PE stock might not be a bargain at all. It could be a value trap that's cheap for a very good reason. And on the flip side, a super high PE might be totally justified for a company that is just about to take off.
So think of it this way. The PE ratio isn't the final answer. It's not the whodunit moment in the mystery, it's the first crucial clue. It's like finding a single footprint at a crime scene. It's not the whole case, but it tells you exactly where you need to start looking. So the real question for you is, what other clues are you going to look for to solve the puzzle?